even though WHEB's been talking about it for a long time now, impact investing certainly in a retail funds context is a pretty new concept still, and hasn't really been formalized or properly recognized until the introduction really of SDR and some of the momentum that went around that. And given our focus, we wanted to focus this, at WHEB, our focus, that we wanted to look at, in this panel at the impact label specifically within the SDR framework, which has other labels for broader sustainability approaches and improvers, which is more about engagement. But the impact label obviously is the one that is most pertinent to WHEB. As Jane mentioned at the outset, it is somewhat fortuitous or relevant or sort of triggering perhaps that it was on this day, our conference this time last year, that the FCA, the regulator, announced the policy statement for SDR. We've been waiting for it for over a year beforehand. We've been involved in the consultation in the lead up to it. And Seb had the honor to be writing a statement for us to publish as WHEB in terms of our response to SDR, while simultaneously hosting panels at our conference this day last year. So it was quite an event, really. But we very quickly moved into sort of moving towards adopting the sustainability impact label. And there was a lot of optimism at the time about the potential for SDR. It was a really well-framed piece of regulation, the potential for SDR to be a sort of well-embraced and adopted piece of regulation. But the industry has found it very difficult to adopt. We're hopeful in the last few weeks that the logjam seems to be starting to ease. And I hope that you'll take away a sense of optimism that we feel that there is still really very much the opportunity and the capacity within using these regulations to capitalize and stimulate more capital, more investment capital to be mobilized towards having a positive impact out in the real world and society and the environment. So with that, we're going to start off by just focusing on trying to make sure that everyone has the panelists help the audience understand what the purpose of the labels is. And Rachel's going to sort of start us off on that side.
Yeah, absolutely. So just starting off with a bit about what SDR actually is. Phil, I was wondering if you could kick us off by saying a little bit about the problems that the labelling regime is trying to solve.
Yeah, well, first and foremost, like many of the pieces of regulation that we've seen from regulators both in Europe and elsewhere, this is about anti-greenwashing, really. It's about making sure that investors aren't being misled about the products. And one way that we described this was the FCA is essentially saying, say what you do, then do what you say, in a nutshell. But actually, they go a bit further. It's not just transparency. They are actually effectively setting a new hurdle that products need to meet in order to be able to claim the labels that they've made available. So they've made it easier to navigate the market, but they've also essentially created a kite mark that investors can trust.
And previously there's been some tension between impact in listed markets versus private markets. Ida, I wonder if you could tell us a bit about impact in listed markets and how the regime views that.
I think we're particularly excited about impact in listed markets because that will achieve scale. And we want people to be intentional. We want people to have theories of change and measure impact and set objectives. And that can be done in the listed markets. Engagement is a very key tool. And we want to have investors broadening the market, and we want to see the market grow and become more effective. One of the issues that came up in the DLAG, the Disclosures and Labeling Advisory Group, which a number of us were on,
yes.
Actually 3 of us were on, was some of the early drafts incorporated the concept of additionality. And I found a good definition, which is a positive impact or outcome that would not have occurred without additional resources or capital investment. So that's sort of causation and very hard to prove. I am a lawyer, but I think additionality is difficult as a concept in any case, and it really makes it doubly hard to invest in listed markets. So I think there's a growing consensus that you can be intentional, you can have a robust theory of change, you can measure your positive social or environmental impact and not have to use this concept, which can be very artificial. We were very pleased to see that the final version of the policy statement had a concept of contribution rather than additionality.
Excellent.
When we thought through kind of examples of what that might mean in real life, it kind of almost sort of underlined how ridiculous it could be. If you kind of think about that in terms of engagement, to prove additionality and engagement, you'd have to get a company to suggest that they were making a change because of your engagement with them and no one else's, and that they were, and that kind of line of sight causation just doesn't exist, and it doesn't take into account the kind of systemic nature of liquid markets.
I agree. Even in private markets, I don't think, what if you need to get some sort of a government guarantee to enable some sort of a blended finance model with government participation or philanthropic participation? The financial investor, did they cause the positive impact? They wouldn't probably have invested without the other interventions. So I think we're on the right course.
Yeah.
And I suppose we've touched on a little bit of what is needed to achieve the impact label just there, but Phil, perhaps with your moniker of Mr. SDR, you could fill us in some more with that.
Yeah, well, I think one of the key points is one that Ida mentioned, which is the idea of a theory of change. So this carefully articulated sort of thesis about what the problem is you're trying to solve and how you're actually going to take steps towards outcomes that you think will solve the problem. Now, obviously, the problems tend to be societal. They tend to be systemic problems that no single intervention would ever trigger a cause for. But when you're talking about public market investments, it might be things like, well, we're going to invest in healthcare because we think healthcare, in particularly certain subsectors, will lead to certain outcomes, and we think that will help the issue of affordable healthcare in general. But you're never going to be able to draw a line and say this investment caused that outcome. You just have to have a theory, and a credible theory, about how that would be delivered. That's one of the main ones. Another that touches on the point that George was making is that they also want a robust and evidence-based method for measuring how the investor contribution is delivered. And that, when the FCA started to, this is one of the problems I think we've uncovered, that when the FCA really started to push that, it started to look like additionality had returned, and that was a problem. And I think WHEB was very successful, I think, in navigating that, saying, look, we will have milestones for looking at how our engagement works. We'll record when there's responses. We'll record when action is taken. These things we can measure. It's very difficult to say we alone caused a change in the world. So I think that's been navigated as well. But all of the labels, the main thing underpinning them is the objective. So the fund needs to state what it's trying to do. So just like you'll say, we're trying to seek capital growth over 5 years, or we're trying to beat this benchmark, we're saying actually we're looking for a positive outcome in the world. Here's what we're seeking. Maybe it's several things. Maybe it's thematic. Maybe it's just one thing. But here's what we're trying to achieve. And here's the theory of change about how we're going to do it.
Which has been quite a philosophical change for the industry, isn't it? Because I think people have typically put their objective about what they're investing in, which isn't necessarily a sustainability objective in terms of what they're trying to achieve.
Yeah.
And that seems to have been the Rubicon that has been difficult for people to cross.
Yeah, and I think we probably won't talk about the other labels today, but the objective is what differentiates them. So the same portfolio could theoretically apply for more than one label. It's about what the manager is trying to do with the investments. So yeah, I think you're right. It's quite a different mindset.
So I mean, we've touched on a few of these points really already, but why has it been so difficult? There was a kind of load of optimism when it was announced exactly a year ago, as we said, and lots of people, sort of, I think there was a suggestion, I think the FCA said that there were 600 or so funds that they thought were sustainable, and they expected, I think Morningstar's research expected sort of 300 or so funds to take labels at the initial phase, which was 31st of July, so you had from end of November through to the end of July, good long period, and like an 8-month period to get this underway. But come the 31st of July, I think there was one fund, and then come the 31st of August, there were 2, including us. Why? Obviously, we've got our battle scars and stories to tell, but Phil, just on a sort of industry level, why so difficult?
Yeah, I mean, I have to say, when you said that the paper was published a year ago, I was thinking, well, it must be dog years, because I've definitely aged more than a year in that time. But I think the point is that these products that we're talking about, they're authorized products. So the FCA supervises them directly. So it's not just the managers that are supervised, but the products themselves. So every change that you make to the product, they get to read it, they get to have their say on it. They can say, we don't like it, they can scrutinize it. And they normally only have a month to do that. But we are at month 9 of a 1-month process in some cases, and that kind of gives you an idea. Essentially, this scrutiny has taken a long time. They have, despite adding resources, I think probably seen this take a lot more resource than they expected. To a certain degree, some of the initial attempts probably weren't very good from industry, but at the same time, I think the FCA didn't really know what good looked like at the start, and that's developed as we've gone along. So we've been on a journey, and I think that's cost a lot of firms, I think, in terms of the amount of resource they've had to put into it.
Yeah. But the FCA has, when the industry or when anyone's spoken to the FCA, as far as they're concerned, it's going pretty well. They're seeing it's doing what it's intended, and as you say, there are 2 kind of aspects of what they're intending. One is to increase trust, sort of reduce greenwashing, if you like, target that, but also improve navigability, so consumers get navigated to the products that are most relevant to them. So, Jake, is the fact that it's been so difficult just a sign that the barrier is high and it should be, or the bar is high and it should be high, because there were a lot of strategies out there that maybe weren't doing quite what consumers would expect, and so it's working in that sense. Is it?
I have a strong view on the FCA. I mean, their motto should be "Can't please any of the people any of the time," and I have some sympathy for the regulator. Oh, I have no sympathy for the regulator, but their default position at the start of this consultation process was that trust was broken in the managed funds world. Now, I've been a fund analyst for 25 plus years. Occasionally, you see some pretty bad actors, right? In the main, I think most fund management groups are trying to be good actors. There are different levels of misrepresentation. You have fraudulent misrepresentation, you have innocent misrepresentation, you have negligent misrepresentation of your skill set. I think occasionally, as a fund analyst, I've seen some innocent misrepresentation where, they've stuck a dolphin or some forestry on their prospectus, which gives the impression that they might be greener than they actually are. I've seen some possibly negligent misrepresentation where they might have said that they do something when they actually don't do it. And I've seen very, very few cases of fraudulent representation. So I think some of the mistake that the FCA made from the outset was just to assume that the whole industry are just full of bad actors. Our industry is not riddled with bad actors. Congratulations, George, on WHEB being the first to get the impact label, because I know, having spoken with 70-odd fund groups, how difficult it is, and I have a lot of sympathy for you going through the process. And the second thing is congratulations on being so collaborative to offer assistance to other fund houses who hadn't been successful. And let me be clear, there are a lot of fund groups who thought that it was going to be an easy-peasy thing to get an impact label, right? And we probably know who they are, some of George's and WHEB's biggest competitors who have really struggled. So WHEB said, look, we can be collaborative here and help you. Why? Because being the only cowboy in town is not enough, is it? You've got to have competition for any label to be successful. So if you're the only impact, what is the point, right? If there are 25 labelled funds in a UK market of 3,000, what is the point? Yes, I'm pleased to see some people coming in now, and I think it's not before time, and I hope that pipeline moves quickly. But in terms of the impact label, what I hope is that the labelling regime as it stands changes behaviours, because that's my fear, that it may not change behaviours. Most of my clients are financial advisors. What is their biggest concern? Well, their time constraints, aligning their clients' objectives to matching it to a product, but also, finally, mis-selling, right? You ask any financial advisor what your biggest fear is, it's mis-selling a product. Okay, they've all been through Arch Crew, they've all been through Woodford. They don't want another sustainability-related scandal in there. So what I'm hoping is that this changes behaviours. Now, typically, any sort of regulatory initiative, I think Guy made the point, taxation is probably the strongest one. Will it change behaviours? Typically, a financial planner has, half an hour to an hour with a client. They've got to cover a whole lot of things from estate planning to tax, blah, blah, blah. Finally, a conversation about product preferences comes in. They have to have, under current regulations, know your client, a conversation around sustainability. If having an impact label makes it easier and more interesting for that discussion to take place, then I think that's where it bears fruit. That's when the funds will start flowing into, the money will start flowing into those funds. So, we saw Guy today. How interesting was that presentation? Okay? Now, that is something that an advisor can illustrate, bring to life in a financial plan. If you have an impact label and you have those interesting stock examples where your fiduciary duty as a financial returns person meets some social or environmental well-being as well, well, it's win-win. And I think if that's what the impact label does, then it will change behaviours. We need more impact people in the labels, and I'm confident that slowly with education, those behaviours, and when I say change behaviours, I mean fund flows, right? You've got to get the money into these funds to make a difference. So that's where I'm hoping this all leads.
So, thank you for that, Jake. As we often say, I think we're pleased to have worked with the industry on this because it's a kind of form of enlightened self-interest, I guess, that we need to see choice in a market for it to be successful, for consumers to use it, to direct capital this way. So in that sense, we finally, Phil, starting to see a bit of an unlocking of the logjam. We're starting to see a trickle. Might it turn into a stream of new funds coming through?
Yeah, I wouldn't use the phrase cowboys, but there are more, but there are more players in the game now.
I should have been triggered more readily by that.
Actors.
But yeah, definitely. So I think, I wouldn't like to say that it's because of the proximity to Christmas, but suddenly a few weeks ago we started to see lots of approvals. So that was very positive, and we've seen them across the labels now. So there are certainly several impact fund options out there. There are a lot more focused products as well. So these are products that are investing in sustainable assets rather than to have impact. A lot more of those, and some of the improvers, the transition products as well. So we're seeing that come through, and I think possibly it's because the FCA has now decided to slightly change tact, and it's going to rely a little bit more on supervision than setting the bar this high and just seeing nobody get over the top of it. Sorry, my voice is very, very loud and it's echoey.
No, that's great. Let's hope that momentum continues through. So Jake, we are one part of the value chain. What is needed then to make the regime a success, make the labels a success, and actually catalyse that money towards space?
It's really important, George. Education is key, right? So let me say one thing. Financial advisors are becoming better educated when it comes to sustainability issues. Gatekeepers like myself are becoming better educated on greenwashing and spotting it and picking it. And the media, funnily enough, are becoming better at sniffing a rat, right? So if you're out there misrepresenting yourself, the press love a bad story and they're going to possibly get you. So you've got all these mechanisms. Now, I've seen greenwashing in action and I know what it looks like. So as a gatekeeper, when a fund manager comes to me and tries to pitch their fund so it can be on the Square Mile Academy, they can't say the thing which is not and expect me to go, this is great. So that education has got to be virtuous, right? So understanding at a stock level what you do is really, really important. And WHEB's reporting, because the key part about impact classification for me is evidence. How does George evidence to me that what they do is having a positive effect on social environmental issues? Now, we know what those issues are, but let me see the evidence. How is it attributable? And if you look at the reports that WHEB produces, the measurement that they've got, it's fantastic stuff, and it's very interesting and easy reading for a gatekeeper like me. Now, the other thing I would say is changing behaviours. What hasn't happened, I don't think, is the FCA's initiative hasn't changed what WHEB does, because WHEB was a good actor long before this regulation came in. But in terms of the education, I think more awareness, and it's slowly beginning to happen. It happens at conferences like these. We all go off and talk about what a great presentation that guy gave. Things like this stick in the mind of a financial planner who's looking for an interesting anecdote. So education, whether it's those sorts of examples, whether it's illustrative stories about shareholder action, or whether it's about how much carbon you've taken out of a supply chain because of a certain thing you did. These are all interesting stories. So, the FCA should be paying more attention.
So that reporting and communication is really important, and it's a big part of the label. So what else is needed in that sense, and what are the labels catalyzed? I think we haven't changed the way we invest, but we have tightened up. We have been pushed by the labels to think about how we structure and frame the way we measure, the way we communicate in a systematic way. What else do we need to do as an industry, and spurred by the regulation to help flow these labels flow capital?
Well, you participated in the Impact Investing Institute's community of practice. I think that we need norms because it's all about consumers, and consumers are not going to be able to compare funds. They're not going to be able to understand funds unless there's some commonality. You've got to compare apples to apples. So having some sort of infrastructure around reporting, and one of the participants in the first session was Impact Frontiers, and they've put together some reporting norms. I think it's 5 required and 1 optional. Very simple, very high level, but just starting to have some framework where consumers can compare. There are particular issues where metrics will be important, and maybe start having some discussions about what the appropriate metrics are. So again, you've got that comparability. But I think the industry can work together on these sorts of things across firms. It's not a competition issue. It's about infrastructure. It's about giving consumers meaningful disclosure. And I'm very optimistic. We do need to present to the IFAs. We need the IFAs to have tools they can use. I've always thought stories are what investors want to hear.
Absolutely.
What
You need
consumers
to
want to
unify
hear.
stories and rigor. It's somehow there's a balance between
Yeah.
that kind of anecdotal piece and something that
Yeah.
has a structure as well.
So keep the overarching structure pretty simple. Some metrics where you're going to see the same issues again and again, and then keep it interesting for both the IFAs and the consumers so they are drawn to impact. Because I personally think with all the controversy around ESG, impact is much purer. It's more tightly defined and hopefully less confusing. So I think it's more about building that infrastructure.
If I could just add something, I think that what's important about the labels in particular is that we said earlier on that you have to state very clearly what you're trying to do. You also have to state at the outset what you will measure. So whereas in the past, I think firms had said, well, we don't quite know what we're going to invest in yet, but we'll come up with sensible metrics for recording it. But obviously, then you would pick the metric that did the best and report that. Now the product has to state on their face what they're going to report. And I think that's very important. And obviously for the IFA community as well, in terms of advising and trying to pick those comparisons like-for-like basis.
Actually, one more thing we mentioned at the meeting was benchmarks and indices. And I think that's going to be quite complex.
I think that's
because
going to be a next frontier, really.
It's
We'll
the
come
next
on to that,
frontier,
yeah.
because what do you look at? Investment performance or impact or a combination of the two, and how do you do that? But that would be the next frontier.
Yeah. And you talked a lot about consumers, how the metrics land with consumers, but there's an intermediary part of the value chain there, which is the advisor or the model portfolio service provider that often sits between us as a manufacturer and then the consumer. So Jake, it's going to be really important when we haven't yet seen that part of the regulation come out yet. It's a bit of a barrier at the moment, but that'll be really important as to how that comes out to catalyse the market.
Yeah.
Are you hopeful about that or fearful about that?
I'm a natural optimist, and I don't think we're heading to sunny uplands or anything like that. But I think the direction of travel for, Square Mile has an MPS, and we're hoping to apply for a mixed goals label in due course. I don't quite know what that's going to look like yet, but what I do know is that if I've got WHEB in my fund, now the FCA has said you don't have to have a labelled fund in your MPS in order to yourself have a label. But if I know that I can rely on the types of reporting that WHEB is producing for me as a fund of funds manager, as an MPS provider, when I establish my objectives and my KPIs, I can see what good looks like and then try and incorporate that into my overall process. So, the whole concept of MPS doesn't change in terms of the bits of kit that we need, but the quality of the kit is very, very important. And I think that's where the label regime will help.
But you'll need the data that we report to you to be consistent and aligned with the data that the other managers in your
Absolutely.
MPS
And we will have our own
That's-
data as well, which sits on top of that, cross-checking what you're providing us with.
Yeah.
And hopefully that's enough to assure our investors.
And that's where we hope, I think, that the community practice that Ida was talking about can be helpful if we can set out some principles standards that we can agree to, that can then mean that we have a commonality when we report to you, that you have something that you can use better.
Yeah, without acting in concert, of course.
Yes, where we had a long...
Not acting in concert.
long legal briefing before the community practice to make sure that we were on the right side of that. And the other part, Phil, that is going to be, that we're sort of waiting for, I guess, in terms of helping to move the process along, is going to be how we get commonality between, this is a UK funds regime, and we need the existing SFDR regulation in Europe to kind of get into a place where it can be aligned and we can have that fungibility across borders can work properly, because that's going to be a problem until that happens.
Yeah, absolutely. And I think it's worth bearing in mind that the SDR labels only apply to funds domiciled in the UK. But if you look at the market of funds available to retail investors, 80% plus of them are actually overseas funds and are out of scope, essentially. So if you look at what this is actually addressing, it's a bit more limited. So it's really important that we start to see a bit more convergence. And the FCA, to their credit, is actually doing a lot of work to try and influence overseas regulators to try and move in the direction of the UK. Whether we'll see a bit of a meeting in the middle or not, I'm not sure. There's certainly some speculation that we might do, but we saw a consultation from the European Commission about changing SFDR in Europe. And it just so happens it includes a number of categories that look very similar to the SDR category. So there is certainly hope there that we'll see them moving in that direction. And obviously we know that a lot of these products are actually under common management, so they may describe themselves in completely different terms, but they are essentially run by the same people, and they're trying to achieve very similar things. So I think it would make a lot more sense all round to have a common approach.
Yeah. So we're going to try and give you a chance to ask questions as well, but just whilst you're gearing up for that, and I'm sure Rachel's got some coming through on the Slido app, this may be the wishful thinking question, I guess, at the end from me, is that initially, and I think when Morningstar did their research, they expect Impact was expected to be the smallest label. I think it was expected to be maybe 10% of all labelled funds, and it was kind of going to be a bit of a niche market. But the FCA's own research and research from other providers like Research and Finance have shown that the consumer reaction to the Impact label is strongest of the group. And we did see in the first instance that the most number of funds that claimed a label were impact. Is that me just wishful thinking on my behalf, or might it have been downplaying impact too much, that as a kind of category, that it was expected to be only the smallest it went in the original kind of framing?
Well, certainly on my part, and not everything that we've seen get a label is in the public domain yet, but certainly I think there is more choice in the impact category in terms of the firms providing it, but I'm not sure that
and the asset classes, I think, as well.
That's probably true, but then I think not necessarily true that there are the most funds now, because some of the houses have got 10 plus funds in the other categories, but you only have a limited pool of providers to select from. So it's interesting how that's broken down. But part of that's because you led the way on how to do the impact funds. So I think the bottleneck opened there first, probably.
The FCA has said that there isn't a hierarchy.
No.
Right?
No?
So
No.
One label is as good as another label.
Yeah.
Now, let me tell you, George, there is going to be a hierarchy, right? Absolutely there is, because, and it's not necessarily a bad thing if the impact label becomes aspirational, right? If WHEB can educate some other fund management groups, and I think it's commendable that you've tried to do that, to get what is effectively, I think, the most intense label to report on. That's not a bad thing, right? But when advisors and portfolio selectors come into choosing a fund and they look at the labels, and if you as a fund manager can prove that there's no separation of financial outcomes necessarily to the end investor and the environmental and social outcomes, fiduciary duty, tick, I'm going to go for impact, right? So there isn't a hierarchy, but there kind of is, and I don't think that's a bad thing if it becomes aspirational.
Okay. Rachel, do you want to?
Thanks very much. Yeah, I mean, I've got some fantastic questions here on the Slido, but I was wondering if our roving mics would like to find anybody who's got a burning question to ask in person. Maybe not right now. Maybe I'll start with a Slido. Oh, there is one over here. Thanks, Vita.
Hello, good afternoon. Just a quick question on green taxonomy. Do you think that is something that's necessary? And if so, do you think it could improve on the EU taxonomy? Yeah. Thank you.
Who'd like to tackle that one?
One of
I've
the
got my
lawyers,
own
I
views
think.
on that, but Phil, do you want to go first?
Well, I mean, I think we put in a response, I think, to the consultation. I think the EU taxonomy is obviously very, very technical. For those that aren't familiar with it, it's essentially almost scientific basis for determining whether a particular business line of a corporate can count as sustainable. It's an extremely high bar, which means that very few companies are able to say that they have business lines that are taxonomy aligned. The UK said it was going to do one. That was a political decision. Anything the EU can do, we can do. It was just after Brexit that we announced that we would do it. I think the reality is we haven't really discovered a reason to have one. So unless taxonomy alignment is going to cure greenwashing, which it isn't because it's such a high bar, or unless taxonomy alignment is going to drive something like a tax break, it's not really clear why businesses should spend so much time going through sort of almost forensic discovery of their business to understand if their air conditioning is taxonomy aligned or whatever it might be, if there's not a benefit to doing it. And that, I think, that's the problem. So the UK taxonomy was going to be different because it might treat nuclear differently from the EU, for example, or there might be differences for construction practices that mean UK construction gets to count when it didn't under EU standards. But apart from those differences, the fundamental problem is there a reason to have a taxonomy? And that, I think, has not been answered. And maybe this consultation that was announced at the Mansion
It's
House.
a very sort of centralized bureaucratic mindset to do that, to say we can tell you exactly which products and technologies are sustainable and which ones aren't. I mean, when I first thought we needed a taxonomy, I was much more thinking about SDR because it's about the right use of language in the right places and to describe what we're trying to achieve. So
It was an experiment. I mean,
Yeah.
it came first, and I think the EU really drove through a lot of sustainability regulation. But I think I agree that maybe that experiment, which you've got to really commend them for trying, maybe wasn't the right way to move forward.
Great, thank you. Ida and George, perhaps after your community practice session this week, you'd like to take this one. Are there any plans for the investment sector to promote consumer use of the labels? And does the panel believe that labelled funds will see more flows than others?
I think labelled funds will see more flows in the sustainability space, right? So you've seen some fund groups move away, some reputable fund houses that aren't going to go for a label, right? Unlabelled with sustainability characteristics, advisors aren't going to be able to get their heads around this, okay? So if you run a centralised investment proposition, labelled definitely, and it's sustainable, I don't know when, but I know there will be more flows into that.
And I think for direct consumers as well, it's, where the whole, the most sort of the thing that people have pushed back most about the labels is that the disclosures to consumers in our prospectus around what we do, around our investment objective and process, have gone from 3 to 15 pages in the prospectus. And as many people say, it's now so long that no one's going to read it. We do now have a 2-page consumer-facing disclosure that goes alongside it that people may read. But the point being, it's very complex, nuanced, and technical in many cases, and too much for people to get their heads around. And the label gives people a way to short-circuit that and to solve for that quickly, a bit like labeling something or branding something as organic or not organic and meeting a standard. And so I think the idea that people will just trust that a fund group is sustainable but doesn't use the label because they have sustainability characteristics detailed in their prospectus is not going to cut through to consumers or advisors.
Or gatekeepers.
Yeah, I would think that having an impact label and having that theory of change and having that evidence around impact, if you care about sustainability, why wouldn't you want that? It feels like a gold standard.
And in terms of promoting the labels, I mean, we've talked a bit about, so we've been working with the Impact Institute to help convene a community of practice, which is specifically about the impact label. There is also an advisors group that's sponsored by the FCA, which is chaired by Daniel Godfrey, which is also working, and I think they're working on a paper that they'll publish in the new year, but I hope they will also sponsor some of that education, Jake, that you spoke about.
Like a good coffee, it's going to percolate right through the industry.
I suppose it's also worth bearing in mind that we didn't mention this earlier on, but it's only products that have labels that can have the word impact or sustainable in their name. So there will be renaming of products that were previously sustainable. I think that parts the sea to a certain extent as well.
Interesting
A lot
to
of
see
it
what they
makes
do.
Okay, great. I think we've got time for just one more question, potentially. This one says, the real change that SDR has introduced is focused on real-world change. Focusing on better ESG, I imagine ESG scores, is not a real-world outcome and has rightly been relegated. Does the panel agree?
Yeah, ESG is an input into any investment process, whether it's sustainable or not, and it should be part of any reputable risk classification scheme. But the nomenclature and the markets have moved on. I think sometimes we get trapped in the old-fashioned language, right? So sustainable, it used to be SRI, it used to be ethical investing. We've moved on, and I think it's good that we have.
And that's one benefit of the labels, is providing a narrative and vocabulary.
And slightly better education. And, I think when the trade press doesn't get enough credit for, you've got magazines now that are dedicated to sustainable investing. ESG Clarity, which is now PA Future, it's all about those stories, and it gets good readership, So I just think some of these topics are much more interesting to a financial advisor's client than talking about tracking error or talking about costs of active ETFs. Or your eyes glaze over if you're a client and your advisor starts talking about that. But something like an organic farm is very interesting.
Great. Before we wrap up, maybe time for one more from the audience? Oh, We've got one at the back there.
Question is always furthest from the mic.
Hi, Jack Rogenfen from ESG Investor. I did submit this question, but I'll just read it out now, which is, now that the SDR logjam is easing, what are the greatest obstacles that still face SDR managers having to deal with SDR and the implementation of the impact label itself? And is WHEB currently working on or applying for any more impact or other SDR labels?
Oh, I can answer the second question first, which is, no, we just take one label. We've got one fund in scope, and the point that Phil was making earlier about interoperability between UK and overseas funds is kind of pertinent there. We have one UK UCITS fund, the WHEB Sustainability Impact Fund, which is in scope to SDR because it's a UK domiciled fund, so it's regulated by the FCA. And that fund adopts the sustainability impact label. You can only, I think one fund can only use one label, unless you use the mixed goals label when you're kind of effectively aggregating more. But so we're focused on the impact label. We also have a Dublin fund, a Dublin ICAV, which is run as parallel to the UK fund, and that is an SFDR, the European Framework Article 9 fund, which is the kind of, that is a hierarchy, and so that sort of sits at the top of that hierarchy. And that's the point that Phil was making earlier, I think, is that we need those two regimes to be interoperable because there are a lot of funds that are domiciled outside the UK and therefore are out of scope to SDR that are sold into the UK that can't use a label but equally aren't regulated by the regime. So you'll get funds that are doing the same thing as another fund in the UK that can't use the term impact, that will use the term impact, and that will be huge confusion potentially in the market.
Yeah. I mean, putting my former hat on, I was at JP Morgan and Capital Group. And at Capital Group, my last job was, I was in Brussels doing policy. And there are ways to talk to the EU. And I think this is one where it's a very specific ask. And firms should go and talk to the Commission and talk to the member states. And because it's so hard to have different labels in different places, I've had to implement that, and it's just unnecessary work and can be very confusing. So I think the FCA is doing work on this. I know Sasha is in those more international arenas, but really working hard. But I think the industry also needs to do the policy advocacy.
And the cost of compliance is another key thing, right? I don't know what your hourly charge is at Eversheds, Phil, but I'm sure it's above minimum wage. The cost of compliance with these regimes is for a small group is proportionally very high. Whereas, the larger groups who have struggled, things have been bogged down with legal. Once you start getting legal involved, it becomes expensive. Once you start having to employ more compliance officers to comply with this regulation, it becomes expensive. Who pays for that ultimately? It's the end consumer because it feeds through to the OCF. And I think a lot of really talented boutique fund managers who have a genuine interest in this area will have been scared by the potentially prohibitive costs, and I think that could be a big factor.
Well, hopefully those will come down as
Yes,
knowledge and
scale.
understanding of it go up. So, yeah. But I think we probably are out of time at that point. So I'm just going to draw this one to a close. But thank you, Rachel. Thank you, Ida, Phil, and Jake. Thank you all very much for a really interesting conversation.